Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you a little idea on what we have in store for today's show. First up, we're going to be talking about a new longevity study that came out from Wells Fargo. The issue of how long we live obviously has a major impact on financial decisions we make toward retirement. So I want to talk about some of the results of the study and some of the possible implications as you do your retirement planning. Our guest is going to be a special guest. He's been with us on the show one other time in a different capacity, but it's none other than Grant Brown. He's a certified financial planner, but he's also the vice president of a company called Compensation Planning, and his expertise is employer-based retirement plans. So we're going to be talking to Grant about those options for those people that may own a business or be self-employed. In our third segment, Fidelity Investments came out with something they called the Investment IQ test, and there's a handful of questions. I thought I'd share a few with the viewing audience and talk about the answers. We'll see how many you can get right. And then finally, in the last segment, it's one I'm still trying to come to grips with, to be perfectly candid with you, the staggering cost of a wedding. A couple shows back, we talked about the costs of actually attending a wedding as a guest and how many people will decline invitations because it's become more and more expensive. And that got me thinking about what the actual cost to get married was, because as I may have mentioned on the show in the past, I do have 3 daughters, and apparently this may become an issue in the future. It's an issue like I had never even considered, so we're going to leave that to the fourth segment and talk about that. But first up is a new survey from Wells Fargo, large brokerage firm and retail bank, and they came out with a survey with respect to the issues of longevity, not just here in the United States, but globally, the idea that people are living longer and longer. Now, it's a multiple-page study. You can find it on their website, but I wanted to pull out some of the things that I thought were most interesting and talk to our viewing audience about those. Let me put up a slide, and I'm going to talk to you one by one about some of these things. The first up is the concept that there's just simply a general aging of the world's population. The reality is we're getting older and older. And here are some of the statistics for 2017. Life expectancies globally are 7 years longer than they were just in 1990. So 27 years ago, they were 7 years shorter than they are today. The reality being people are living longer. Also, with respect to general aging of the population, birth rates are falling. I found this to be fascinating. It's one of those things you sort of know intuitively, but when you see the statistics, they're particularly surprising. Birth rates here in the United States have dropped by 50% since 1950. Average number of kids that a couple had in 1950 was almost 5, and now it's down to under 2. So the rate has dropped by more than 50%. And finally, issues of better public health mean people are living longer. And some of the things I never considered, the decrease in the smoking rate in the United States, increase in people exercising regularly, I'm not included in that list. And then finally, the incidence of people actually getting flu shots is having a dramatic impact on how long we live. So the general aging of the population. Next on the slide, the issue that there are fewer workers per retiree. Now, this has far-ranging implications for programs like Social Security, as well as a whole host of other public policy issues where the focus may turn from working-age individuals to non-working age individuals as the bubble of baby boomers moves up through the population. That crowd of people that was born between 1950 and 1960 or so, or 1945 and 1960, depending on how you want to define the baby boomer generation. By 2030, 1 in 5 U.S. residents is expected to be over 65 years old, and that is a staggering statistics. Workers, the worker to retiree ratio by nation is changing radically. Currently, the U.S., it's 5 workers to 1 retiree. That's way up from where it was when things like Social Security began. In Europe, it's only 4 workers to 1 retiree. In South America, the number's a little bit higher with 9 workers per retiree, but a shrinking ratio across the board. Last thing on the slide, finally, increasing retirement age. Now, this is a statistic that could work in our favor to some extent. The retirement age is steadily increased for women from the low to mid 50s, where in fact many women didn't even retire back in the 1950s because they weren't working. Now the average retirement age for women is 63. And for men, it was actually in the 1950s, it was about age 65. And by 1990, it had actually dipped to about age 62. But since 1990, it's rebounded quickly. It's up around 65. And most analysts expect it may go to 67 or more, of course, where full retirement age is for many people now in the Social Security system. So some really sobering statistics, and you have to appreciate where you're at with respect to saving, because as we live longer, it has a variety of different implications for healthcare costs, funding of different programs, how much we need to save. So I thought it was an interesting study. If you have some time, definitely check it out. All right, up next, our guest will be Grant Brown. He is with Compensation Planning, and we're going to be talking about small business retirement plans. So stay with us. We'll be right back. Welcome back to the Money Pros. I'm joined now by our special guest, Grant Brown, Vice President with Compensation Planning, somebody I've had an opportunity to, great to see you, to work with as well as socialize with and a whole bunch of other things. So glad to have you on the show. This is actually the second time, because first time we had you on the show was in your capacity as a member of the leadership for the local Financial Planning Association. So we're actually going to talk about your
daily business.
Your daily business, precisely. So, and that is small business retirement plans. That's what compensation planning focuses on. So let's talk about that. And the first question I want to ask is, as a small business owner, why would, and some of the answer may be obvious and some of the answer not so obvious, why would somebody even want to consider dealing with a small business retirement plan? I mean, I'm a small business owner. It's a pain in the neck. So why does somebody want the added hassle of dealing with something like that?
Yeah, I mean, I think first and foremost, people also don't like the hassle of paying taxes and sending a lot of money to the government. So the tax write-off, the tax benefits of establishing a plan for the small business, often we see as the leading reason to establish one.
So that's the driver is, every year you pay your tax bill and you go, geez, I'm just sending a staggering amount of money to the U.S. government, to the state of wherever my business is located. And so that's what you're seeing as the primary motivation. Hey, it's not about any other issue. It's, can I somehow lower my tax bill?
So that's for the small business. We tongue-in-cheek say sometimes the smaller the plan is, it seems like an employer benefit plan, whereas as you have more employees, the driving of the setting of the plan becomes more of an employee benefit plan.
Interesting,
so
okay.
It's a function of wanting to set up a plan as a way to attract and retain your employees, and really become more maternalistic or paternalistic, and making sure that your employees are going to be put in a position so they can actually retire at some point, so they're not going to be forced to still be working for you when they're 70 and older, and going to end up costing you again a lot more in healthcare costs and other factors.
And that's an interesting point, because we had a guest on a prior show, actually my partner Matt Sweet, and we were talking about retirement planning and the shift from defined benefit to defined contribution plans. And the first retirement plan, I think he said, was created by American Express for exactly that purpose, to create a dedicated, committed workforce that wasn't, didn't have to work forever, essentially. And that ties in well with the longevity stuff that we were just talking about. So what you're saying is the two purposes being generally the tax benefit and the employee benefit, it shifts as the company gets larger what their primary goal is.
Yeah, and some people do even if as a smaller business, they really value, they see their employees as family, and it's critical to them, not so much for their own tax benefit purposes, but making sure that even their handful of employees are well taken care of.
And I've even seen situations where the employees press the employer because
Absolutely.
They realize it's something that they need, and so the employer starts to look into it, valuing the employees. So I think there's a lot of confusion among business owners about what a small business is and whether they're even eligible to open a small business retirement. What are we talking about when we talk about a small business?
So basically, if you have a business, whether you have employees or not, so that can be a sole proprietor, that can be a partnership, a C Corp, S Corp. Basically, if you're making money that you're paying Social Security income on as a business, you're able to establish a retirement plan. And there's a number of different retirement plans that might be available to you.
And that really scoops in a lot of people that might not think of themselves as business owners. I was talking before the segment started about a doctor I spoke with who receives a 1099 from a company because she works in an emergency room from time to time.
Sure.
She's in effect a business owner, right? Because she has to file a Schedule C, and
exactly.
So she is eligible for types of retirement plans that aren't available to
an employee.
employees.
Yeah.
So that's who we're talking to. That from that situation all the way up to somebody that might, run a plant and have employees and sort of what we think more classically as a small business owner. Next question. What are the we throw around a lot of acronyms in this business. There's a lot of different lingo. What are the primary types, and this is not meant to be an exhaustive list either, of retirement plans that are available to small business owners?
When I look at it, I kind of take a top-down approach. So the starting point to look at in the simplest form is often something called the SEP. The next step from there often is called a simple IRA. Then we look potentially at a 401k, which is a type of defined contribution plan. And then for those clients looking to put a lot more away, we'd potentially look at a defined benefit or cash balance plan.
So you started at the bottom with the SEP, which is oftentimes the first thing the first type of retirement plan a small business owner is ever directed to, simple 401k and more advanced plans. So can you walk us through, obviously we don't have a ton of time, but can we touch each one of those plans, and can you talk about the major distinguishing characteristics of each one and why somebody would want to consider or not consider one?
Sure. So first and foremost, the SEP is really only a vehicle for employer contributions to be contributed. There's a little bit longer waiting period for if you did have employees that weren't with you as long, you may be able to not have to include them in the plan depending on what your objective is. But you can essentially put in around 25% of whatever your compensation is. So if that meets a client's goals, that might be a great fit because there's not annual tax reporting and it's very easy to open and establish. You don't need a company like us to take care of some of the more complex compliance work.
And that's why we see the SEP as sort of the first one in. Somebody like that doctor I was talking about, no employees, filing Schedule C. SEP is super easy to set up, no reporting, very cheap, so that's a great first option.
Super easy to set up, but with that said, it's still amazing how much non-compliance we see that people don't understand what seemingly is basic rules.
You can screw up anything. I think that's a lesson we've all learned. All right, so next up the ladder, we were talking about the simple.
Yeah, so next up is a simple, where that really provides a vehicle for employees to also put in their own money. So an employee, including the owner, can put in up to $12,500, a little bit more if they're over age 50. And then the employer has an obligation to put in, the most common form you'll see is a 3% match of what an employee puts in. And again, there's a little bit, about a 2-year potential waiting period that you can have. So may or may not be the right fit depending on how much and how long people have.
So now we're getting into a scenario where with employees, the employer, and I know the SEP has this use too, but oftentimes people don't use it this way, but a situation now where the employer is going to have to start thinking about giving money to employees. It's not just about putting away their own money, but actually giving more compensation to employees.
And driving behavior to have employees put in their own money.
Because that helps the employer and their ability to put in more money in most circumstances, right?
In the 401k world, that's the case. So in the 401k, which is kind of the next, kind of moving from the junior varsity simple plan to more the varsity 401k, the limits really dramatically increase, and there's a lot more flexibility that's brought into play in those plans. So in a 401k, the employees can put in about $18,000, and between what an employee puts in and the company might put in for the owner, someone could have about $54,000 added to their account, or $60,000 if they're age 50 or over. So it's a much, much higher amount that is able to go into those plans.
So let me just interrupt you there. We're talking about the 401k, and I think most people that think about a 401k think about that as a big business retirement plan. But that's really not the case. You don't even have to have employees for a 401k.
Yeah, we deal with a lot of 401ks that only have really only the owner or no employees. The reason is some of the limits, the way, depending on what your compensation is, that may be a better solution to get more money into a retirement plan for you. So every situation is really different.
So on the plus side of the 401k, you can get a lot more money in, and there's a lot more flexibility in terms of arranging the plan. But that also comes at the expense of potentially higher costs and more complexity, right?
Exactly. So since all these are kind of overseen by IRS and some of the Department of Labor, you want to make sure you have the proper structure in place, you're following the rules. And so with a 401k, there is actual annual reporting that needs to get taken care of, Form 5500, which is kind of our role in helping companies with the 401k.
So what are the main considerations that an employer, if they're thinking about putting in place a plan, should be thinking about as they evaluate these different plans?
I think first and foremost is, what's your budget? I mean, how much are you looking realistically to shelter into one of these plans? Since if you're really only looking to put a couple $1,000s away, you can do an IRA. If you're looking to do $12,000, maybe a simple will fit your bill. If you're looking to do more, maybe a 401k or a DB is the right fit. On top of that, it's depending on how many staff you have, how long they've been with you, your specific company's demographics are going to drive the cost as far as what you may have to give to your staff in any one of those plans. So it's really important to look at the longevity and the ages of your employees, comparing with what your objectives are to figure out which one of those four potential plans is the best option.
And with just a few seconds left, it's a complex decision. Who are the professionals, generally speaking, that somebody would talk to get advice about how to do this?
Yeah, I mean, I think naturally people are already dealing with their accountants and their advisors. Again, because this is a very niche area of the tax law, it's important that if you are going to be taking advice, that you know they're comfortable in that specific realm. Also, reaching out to a third-party administrator like ourselves or someone else is the appropriate venue for a 401k or DB, but you should also make sure they're comparing a SEP or a simple, because those are options as well that may not require them, but they'll want to compare.
All right, Grant, I'm going to hold you there because we're out of time, but we're going to have you back because there's obviously a lot more to talk about. All right, thank you. Stay with us. When we come back, we're going to talk about Fidelity's retirement IQ survey. How are you going to do on those questions? Stay tuned. There's more to come. Welcome back to the Money Pros. So here in our third segment, I want to talk about something that just came across my desk, and that's the results of a survey that Fidelity did. Fidelity Investments, of course, based here in Boston, did recently called the Retirement IQ Study. And there was a series of about 8 questions. They retained an independent surveyor to do this online with a variety of different demographics. And I wanted to share some of the questions with the audience, and you can ask yourself, how would you do on some of these questions, or what are your preconceived notions of these questions? So let me put them up and we'll talk about them. And the first question in the Retirement IQ study that I wanted to share is, how often over the last 35 years has the stock market returned a positive result? And this is a question that I find when I ask varieties of this question of my own clients, prospective clients, a lot of people get this wrong. So the answer, actually, in the past 35 years, 30 out of the past 35 years have been positive for the stock market. In the survey, only 8% of people got that right, and only 14% of 55 to 65-year-olds. So that's an important thing to consider as you're planning your portfolio. If you have a misconception about how risky or not risky the stock market is, you may make decisions that are ill-informed. So that's something you have to be very cautious of, and for some people that answer is surprising. Next answer, or next question, and that is, what is typically the largest single expense in retirement? And this is another question that I like to ask clients to see what their notion of what their retirement is going to look like is. For a lot of people, the answer would be healthcare, and we talk about healthcare a lot on the show, but by far the largest expense for somebody in retirement is housing. For many people, that can be as much as 50% of their monthly living expense. Only 17% of respondents answered that correctly, and 69% thought that, in fact, the largest expense would be health care. Also of note is health care is the item that people are most worried about being able to afford, which brings us to question number 3. And that question is, what is the average out-of-pocket healthcare cost in retirement? So over the duration of your retirement, what on average will somebody spend on healthcare? And Fidelity actually tracks this number and estimates that for a 65-year-old couple retiring in 2016, over the life of their retirement, they will shell out $260,000 in out-of-pocket expenses, meaning not covered by insurance or Medicare, for health care. 72% of people underestimated this true amount, so didn't realize how much it was going to be, and 22% underestimated it by $200,000 or more. Obviously, this is a number that's going to vary greatly, and it's very hard to pinpoint, but having an idea of the average numbers is important. All right, so those are 3 questions. Ask yourself how you did. We're trying to keep you informed so you get the right answers. Stay with us. How much does the average wedding cost? I'm going to give you those numbers. You're going to be surprised. Stay with us. Welcome back to the Money Pros. So a few shows back, we talked about the high cost of attending weddings and how many people will decline invitations because it's prohibitively expensive for them to go to 1 or 2 weddings a year, as expensive it is. That got me thinking about what the actual cost of getting married is. Now, I got married 25 plus years ago, and obviously the expenses have changed over time. And the other thing that regular Money Pro viewers will realize is that I actually have 3 daughters. And when I tell people that, I get more comments about, am I worried about the cost of marrying them off? I get that question more often than I get about how worried I am about sending them through college. And I thought, is it really going to be that bad? So maybe I actually should check out the expenses. Boy, I'm not so sure I'm glad I did that. So here's what I found. I found a website called theknot.com. They're the largest wedding-related website on the web, according to them. But they surveyed 13,000 people to get an idea of what their wedding costs were. And I'll tell you what, when I first saw these numbers, I said, this cannot possibly be right. But let me put those numbers up and we'll talk about them. All right. According to the Knot.com's 2016 wedding survey, and these numbers just came out about a month ago, the average cost of a wedding in the United States is $35,329. That is a staggering amount of money to me. I'm not even sure I could plan a wedding that would cost $35,000. The next bullet, the most expensive place to get married, not a total surprise here, Manhattan, that costs $78,464. And then to get things a little bit closer to home, Rhode Island, boy, this is no bargain. The average cost of a wedding in Rhode Island, $52,328. Let that sink in. Now, I know there are those of you out there that are planning a wedding, or your parents or the kids, and you're like, yeah, that number sounds about right, Oliver. Why are you so incredulous? Because that is a lot of money. And I didn't believe it until I actually talked to somebody here at the station associated with the Money Pros who was indicating that they're about to get married later on this year and will be spending more than those numbers. And I won't be any more specific than that, but it was really a shocking number to me. So I'm struggling with this. This is going to be a subject we talk about more here on the Money Pros. We'll save it for later. Thanks as always for watching. We look forward to seeing you again here next Sunday. Take care. Have a great weekend.